Hello everyone, welcome to this investor analysis video. So today we'll be looking at two Indonesian consumer good companies that are both listed on the stock exchange. PT Garuda Food Putra Putri Jaya Tbk with ticker code GOOD and PT Mayora Indah Tbk known as MIOR. So both of these companies operate in the food and beverage industry with well-known brands in snack, biscuits, confectionery, and beverage. Good is behind popular brands like Garuda, Gary, and Chocolatos, while MIOR is famous for Roma, Kopiko, Torabika, and Energen. And the purpose of this video is to compare their financial performance using key investor ratio. First one is earning per share EPS, price to earning ratio PER, dividend payout ratio DPR, dividend yield DY, retained earning, and market to book ratio. So by the end of this session, we'll be able to see which company looks more attractive for long-term investor. PT Garuda Food Putra Putri Jaya, better known as Good on the IDX. The company is one of Indonesia's largest snack and beverage producer, famous for brands like Garuda, Gary, and Chocolatos. Garuda Food listed on the stock exchange in 2018 and has expanded export to Asia and Africa. Two most revenue still comes from Indonesia. PT Mayora Indah or MIOR is a more established food giant listed since 1990. It's known for global brands like Kopiko, Torabika, Energen, and Roma. Kopiko in particular is sold in over 100 countries, giving MIOR a strong international footprint and consistent earning growth. Let's begin with earning per share or EPS. So EPS measures how much profit the company generates for each share outstanding. And this is often the first metric investors look at because it reflects the profitability directly. For Good, EPS was strong in 2018 at around 58 rupiah, but since then it has been on a steep decline. By 2022, EPS had fallen to just 3 rupiah, which is a massive drop of more than 90% in only just a few years. Although there was a slight recovery in 2023 to about 5 rupiah, the long-term trend shows serious weakness in profitability. But on the other hand, MIOR or Mayora tells a very different story. Its EPS has been consistently strong, peaking at more than 93 rupiah in 2020, dipping in 2021, and then surging to a record 145 rupiah in 2023. This rebound highlights MIOR's ability to recover and grow profit even during challenging years. From this comparison, it's clear that Mayora demonstrates resilience and strong profit growth, while Good struggled to maintain the earning.
Next, let's take a look at the price of earning ratio or PER. This ratio tells us about expensive a stock is compared to its earning. A high PER means the stock is expensive relative to profits, while a low PER suggests it may be undervalued. Good's PER has been extremely volatile. In 2022, it charged a shocking 170 times earnings, meaning investors were paying 170 levels. Even in 2023, PER stays high at over 90. In contrast, MIOR's PER is much more stable and reasonable. It has remained mostly between 17 and 33 times earnings, which is typical for a strong consumer goods company with growth prospects. These comparisons tell us that Mior is priced fairly relative to its performance, while Good looks overvalued and unstable. Next is the dividend policy DPR and D1. Dividends are always important for investors who want income from their shares. Here we will analyze both the dividend payout ratio or DPR and the dividend yield or DY. The DPR shows how much of a company earnings are paid out as dividends. A sustainable payout is usually between 30 and 60%. Mior consistently maintains its DPR in this healthy range between 30 and 55%, which means it rewards shareholders while keeping enough profits for reinvestment. Good, however, shows a worrying pattern since 2021. Its DPR has exceeded 100%. In other words, the company is paying more in the dividends than it's earning in profits. In 2023, DPR reaches over 200%. This is highly unsustainable and suggests the company is relying on reserve or debt just to maintain dividends. Now, let's turn to dividend yield. Both company ended up with a yield of around 2.2% in 2023. At the first glance, this looks similar, but the story behind it is very different. For Mior, the yield comes from strong and growing profits. For Goods, the yield looks attractive, but it's achieved by paying out more than it earns, which cannot last forever. So again, while both pay dividends, Mior approach it's healthy and sustainable, while Goods dividends policy raises red flags. Next is the return earnings or the percentage of RE. RE shows how much profit a company keeps to reinvest for future growth. This is especially important for long-term investors. Mior consistently retains around 60% of its earnings, which indicates a balanced strategy, rewarding shareholders while keeping capital to expand. So, the Goods unfortunately has been in negative territory in recent years. In 2022, retained earnings dropped to minus 190%. This means the company isn't keeping profits, it is consuming reserve, a clear warning sign for sustainability. In short, Mior is reinvesting for the future while Good is depleting its base.
The market-to-book ratio compares a company's market value to its book value. A higher ratio indicates stronger investor confidence. Goods market-to-book ratio has been fluctuating between 3 and 6, while Mior has also similarly fluctuating between them, even peaking near 7 in 2018. Overall, both companies remain attractive to the market, but Mior's consistent earnings and global brand recognition explain why investors continue to value it highly. To wrap up, let's look to the radar chart summarizing all key metrics. As you can see, Miora clearly outperforms in almost every area. Higher and more stable EPS, more reasonable PR, sustainable dividend policy, and strong retained earnings. Garuda Food only look attractive in terms of dividend yield, but this is achieved through unsustainable payouts that weaken the company's financial base. For investors seeking stability and growth, Miora is the stronger choice. Garuda Food may appeal to the short-term dividend seeker, but it carries much higher risk. Thank you for watching this analysis of Garuda Food and Miora. I hope this helped guide your investment decision.